Good afternoon, everyone, and thank you so much for joining our webinar today, Covert Taxes, Spying Issues in Health and Welfare Benefits. My name is Amanda, and I'll be your moderator today. ERISA attorney Larry Grudzien is our presenter. Having read over the slides, it's clear that this is a really just jam-packed resource. So if you miss something, don't worry. We'll be emailing you a recording and the slides after the webinar concludes. We have a lot of participants today, so I'll be keeping the webinar muted to avoid any background noise, but Larry will pause periodically for questions. Just type your question in the box below and I'll read it aloud for you. Our next webinar will be covering FSAs, and it's on March 7th again at 1 p.m. Central Time. For now, I'm going to turn the presentation over to Larry.
Amanda, thank you very much. Before we begin the presentation, I'm going to give you an update of what I think is going to happen with ACA repeal and replacement. I've gotten a lot of questions from my clients about what's happening and putting the crystal ball on what do you think is going to happen. And a lot of people are very anxious because since Trump issued that executive order, people expected this for ACA to be repealed and replaced quickly. Well, the problem is, and I think everybody involved is understanding, that repeal and replacement is going to be extremely complicated. And it's not going to be done overnight over the next few months. Any repeal and replacement may not be in place until later this year, and if that's the case, then any change may not happen until 2018. 2017, we may have to still live with ACA and all its requirements, and it's going to be interesting to see what they do with it. I think what they're playing with and what they're concerned about, and one of the more popular provisions of ACA is the pre-existing condition exclusion, and how to deal with that, how to modify that to be less costly, and how not to take away coverage from millions of people. Another area that I think they're trying to deal with is the Medicaid expansion, because those individuals, if anything happens and millions of people or thousands of people they lose their coverage, it's going to be very a touchy situation. Now, ever since Trump was inaugurated in January, there's been a lack of any guidance from any of the agencies. It's been kind of sitting around for a while. I know he's been busy with issuing executive orders, but the Congress has not really passed anything, and everything is kind of like in a mode of trying to figure out what to do. So be patient. If you don't like ACA, I think I'm sorry, but it's going to be around for a little bit longer. Everybody thought that the ACA reporting requirements were going to go going away. That's not the case. People are moving forward on that. So until further notice, I just want to warn everybody that the requirements of ACA are going to be in place at least, I think, until the end of 2017. Now, it's going to be interesting to see what the Congress does about some of the requirements, whether they're going to repeal the penalties for doing the ACA reporting. So only time will tell what will happen. So that's my little spiel on ACA repeal and replace, and stay tuned. We'll have something as soon as anything happens. We'll have something discussing the developments of that. So what's the purpose behind today's presentation, and what are we doing? What's important to understand? When you have an employee-employer relationship, an employer gives employee a payment. Unless it's excluded from the Internal Revenue Code, any payments to employees are going to be taxable. So what I'm going to be discussing is those benefits that are excluded from the employee's income. The employee gets a deduction for it. Because what employers are concerned about is, well, if I give something to an employee, do I have to withhold income tax, Social Security, Medicare, and any payments? And as I said before, unless it fits one of the buckets that you're going to be seeing here, yes, you have reporting responsibilities, you have withholding responsibilities. But if it comes under one of the sections of the Internal Revenue Code, which I'm going to be talking about in the next few minutes, no, it's going to be excluded. And this is something that I think when they give a benefit to an employee, you have to understand that in many situations it's not going to be non-taxable, but it may be taxable. So let's go through this. So the first thing I'm going to be talking about is health and accident benefits. And these are all the different types of benefits that are included in that category of health and accident benefits. These are hospital benefits, surgical, accident and sickness benefits, major medical, dental, vision, prescription drugs, mental health benefits, alcohol and drug dependency, ADD, and certain disability benefits. And the purpose behind these benefits is the payments to employees in the event of personal injury or illness. They can be either provided through an insurance contract or self-insured. Now, self-insured is becoming very popular. In the past, an employer didn't self-insure until they had at least a couple hundred employees. Over the last probably 3 or 4 years, 5 years, even smaller employers have decided to self-insure, providing benefits to employees, especially health benefits. If an employer provides health and accident benefits to employees, they can deduct the payments as ordinary and necessary business expenses, and these payments are excluded from the employee's income. So there's no withholding. Now, please remember, and under certain circumstances, and I'll be covering this at the end of the seminar, providing benefits is, there are some limitations at which you can deduct. And especially when you start self-insuring your benefits. There are certain sections of the Internal Revenue Code, sections 418 and 419, 419A, put limitations of which you can deduct. Now, the reason why this is a concern is that, especially if you're self-insured, what you want to do is create a reserve to make sure you can pay for benefits in the future. If you're insured, basically the premiums come in, you pay for it, you get a deduction for it. There's no problem. It gets somewhat interesting and complicated when you start self-insuring any of your benefits, your health, your medical, your dental, your disability. In that situation, there's certain limitations, which I'll be covering, on what type of reserve you can maintain and still get a current deduction for it. So that's extremely important. So amounts paid by the employer to finance sickness and injury benefits for its employees are generally tax deductible as an ordinary and necessary business expense, as I indicated before, and this is under Code Section 162, provided they are used to pay accident and health insurance premiums or otherwise actuarially determined. So again, I'll be talking about the limitations in those benefits. And timing of those deductions depends on whether the employer is on a cash or accrual basis. Now please remember, the accrual basis, as this slide indicates, is in a taxable year on which all events have occurred that determines the liability, and the amount of the liabilities can be determined on a reasonable basis. At that point, it's not when you pay the expense, is when you've incurred the obligation to pay the expense. That's on the accrual basis. Now, up until a few years ago, self-employed individuals could not take a deduction and there were limitations on how much they could take a deduction for these types of benefits. So as this slide indicates, the Tax Relief Act of 1997 amended the Self-Employment Insurance Act of 1995 to extend and expand the percentage of deduction of self-employed individuals. This is Code Section 162I. For tax years 2003 and afterwards, a self-insured individual can deduct 100% of their insurance premiums. And this is important, especially for those individuals that are considered to be self-employed. It's not just partners and sole proprietors, it's also who are also considered to be self-employed are more than 2% S Corp shareholders. So they can take a deduction for the amount they pay for the premiums and for coverage on their 1040. So again, the amount of deducted deducted cannot exceed the taxpayer's net earnings. Deduction does not reduce the amount of income subject to Social Security tax. Remember, self-employed individuals, partners, and subchapter as shareholders may not participate in a cafeteria plan or a health reimbursement arrangement for this reason, because they take a deduction for it. They're not considered to be an employee. So they can, and especially what's important, if the employer pays for any part of their premium, that payment will be added to their income because they can take a deduction on their 1040. So again, if you're self-employed, there's a special arrangement there. Because of sickness and injury benefits or forms of compensation, deductibility depends on reasonableness of the amounts in each case. Now, what medical expenses are deductible, or under Code Section 213D, determines the types of medical expense that individuals are permitted to deduct when filing personal taxes, which the employer provided qualify for exclusion. Now, eligible medical expenses, this is an important definition under Code Section 213D, as defined as payments to cover either a diagnosis, cure, mitigation, treatment, and prevention of disease, or transportation primarily for essential for medical care. And basically, the IRS has indicated these expenses include those incurred primarily for the prevention and location of a physical or mental defect for illness. Now, what does that mean in layman's language? Under 213D, you can only take a deduction for treatment of an illness. It cannot be for the general well-being of your health. So, for example, I'll give you an example of that. As an employer, I've decided that health is extremely important. So what I'm going to do is I'm going to pay for a health club that all my employees can go to, and they can exercise and be in better health as part of my wellness program. Now, if it's support the general health of your employees, that health club membership or the monthly dues are not deductible medical expenses. The payment of such would be not come under this definition and would be taxable to the employees. But let's say you have 3 or 4 employees that they're obese and their doctor said you have to exercise. For those employees, because the fact is for the treatment of a disease or prevention of a disease in that situation, and because they have a doctor's note indicating they have to exercise, for those employees, that expense would be considered to be a deductible medical expense and would be excluded. So again, this is an extremely important limitation, and especially it becomes very important when employers are putting together wellness programs. Employers are giving employees all kinds of different devices and different things to help them with their general health. And generally, in most of those situations, those devices will be taxable because it's for the general health of the employees. It's not for a treatment of a disease. So therefore, those devices would be taxable to the employees. And so anytime you put together a wellness program, you have to, again, you have to meet certain requirements, and you have to meet the requirements under HIPAA, under GINA, but also you have to determine anytime you put together a program, especially a wellness program, are any programs under this wellness program, would those benefits be taxable? And if it's to support the general health of the employees, generally, in that situation, it would be taxable. Certain things are not tax deductible. Cosmetic surgery is not tax deductible. The definition of cosmetic surgery is intended to correct a physical deformity resulting from congenital abnormality, accident, trauma, or disfiguring disease is not considered cosmetic. So again, certain things are, and certain, if they are considered to be cosmetic surgery, then it's tax deductible. If it is for the, again, is to correct a physical deformity, it would not be. Now, medicine and drugs includes items that are legal and generally accepted by medical community, whether or not require doctor's prescription. If it's over-the-counter drugs, again, part of ACA, and let's see if this disappears, non-prescription drugs would not be reimbursable unless it's according to a prescription. That's one thing that we have to look at and see. That's one thing that ACA did away with. And let's see if that restriction will be lifted when the ACA is repealed. Deductible under certain conditions, capital expenditures. This could be a lift chair. This could be all kinds of different things that could be deductible. Deductibility for transportation expenses. Deductible if paid for transportation is primary and essential to medical necessary care. Doctor visits, those trips would be, again, would be deductible. Does not include meals or lodging if occurred while away from home or receiving medical care. And some types of institutional would be medical care. It's for the treatment of a disease. Now, where does this all, under the Internal Revenue Code, exist? This is under code sections 104, 105, and 106. Under 104A, this section excludes from personal income benefits received from accident and health benefits and sickness or disability fund if premiums or contributions are paid by the employees. Includes 105A includes gross income benefits for employer provided. It excludes from income benefits from employer provided health plans. 105B exempts amounts by the employer to reimburse medical expenses, and 106 excludes the value of employer provided health and accident coverage. So these are the sections under code section 104, 105, and 106. This is where the exclusions for medical care come into play. Also, in this situation, payments to dependents and spouses for medical care are excluded from the employee's income. Dependents must meet the requirements of Code Section 152 modified by 105. What does that mean in layman's language? It means that basically you can, dependents include, for example, qualifying children or qualifying relatives. The exception to that is under ACA for medical. You can exclude for children up to age 26. It doesn't matter if they're tax dependents. It doesn't matter if they're living with you. That's an exception. And all intents and purposes, basically, it looks like that's going to remain once ACA is repealed. It's a very popular provision. One thing to be careful with, especially if that age 26 rule, please remember that rule does not apply to reimbursements from health reimbursement accounts. Under that situation, the individual has to qualify. It's either a qualifying relative or qualifying child. So please, medical care, no problem. Child under age 26 can be covered, but again, for health reimbursement arrangements, that's a different story. Now, also medical status, again, determined under state law, and that's more, instead of same-sex marriage, that's more in a sense of, does the state recognize common law marriage? If you, in many states will recognize common law marriage at the time that the marriage was formed, it's in a state that recognized common law marriage. If they move to another state, that depending on the state law of that state, whether common law marriage is going to be recognized. Retiree health and long-term care. Generally, payments to retirees to health medical costs are included in the personal income. It's got to be, in that situation, pursuant to a plan, because that exclusion will come under 104, 105, or 106. It includes former employees. And long-term care is treated as any other accident and health contract, so it can be excludable. So again, what many employers are doing with retirees, what they're doing is they're forming a retiree HRA, health reimbursement program, and giving employees money to pay for premiums or pay for expenses, especially when an individual reaches age 65. In that situation, they are covered by under Medicare. Here, what they could do is provide money for premiums or money for expenses, and one of the issues why many employers are doing away with retiree coverage was because of the fact that the costs are escalating. So one way an employer can do this without having escalating costs is saying, I'm going to give you X amount per year for retiree medical, and you can use that money under an HRA to pay for expenses or supplemental coverage. So that's something that can be done. Now, non-discrimination rules, remember as part of ACA there were supposed to be non-discrimination rules for insured plans. They were supposed to go into effect in 2000, I think 10 or 11. The IRS has never released any guidance on those rules. So right now, what I'm advising my clients to do, until further notice, and I don't think they're ever going to see the light of day, is that as long as you separate your employees' unemployment classes, you can have different insured products for different employee groups. So you could have one plan for executives, one program for the salaried, another program for the hourly. There's no problem. As long as it's employment-based, there's no issue with age or race or sex discrimination. And so that's going to continue. So you can still have carve-out programs for your executives because the non-discrimination rules for insured plans have never seen the light of day. So as long as it's provided by insured products, there's no problem. The issue is more complicated with self-insured plans. With self-insured plans, you have to contend with 105H. And 105H is there's two set of rules. One set of rules are for eligibility requirements. The other set of rules are for benefits. And under the eligibility, as this slide 13 indicates, you have to cover at least 70% or more of all employees. 80% of employees are eligible as long as 70% or more employees are eligible to benefit. And the last one, the non-discriminatory classification. Now, one thing to remember about these rules, the eligibility. You don't have to include everyone in your plan if you're self-insured. But what you do is you have to include enough lower paid people in your plan. And as a rule of thumb, I say if you're going to create a self-insured plan, you have to cover at least 20% of all non-highly compensated employees in order to pass this. So most employers cover almost everyone, there's no problem. But if you want to put a plan in for a location or a division, you have to be very careful about these eligibility rules and then make sure that your location or division doesn't have a concentration of higher pays. Because if it does have a concentration of higher pays, then you're going to have a problem with the eligibility test. So here the second rule is the benefits test. Under the benefits test, generally to pass the benefits test, it relates to discrimination. You can't have contribution levels, waiting periods that benefit highly compensated versus non-highly compensated. You can't vary benefits according to age, compensation, or years of service. And types and amounts of reimbursement medical expenses must not favor highly compensated. So if you have, for example, one waiting period for the executives, one for the rank and file, each level of that feature has to be tested, and you have to meet the eligibility test to see if it's discriminatory. So it's extremely important to understand that if you start putting different rules for different types of benefits or features under a plan, each one of those different benefits have to pass the eligibility test, and that's the problem. So under Code Section 105H, a self-insured medical expense reimbursement plan is discriminatory for benefits if the type and amounts of benefits to the highly compensated are not available to the rank and file. What is the definition of highly compensated? For this reason, the definition is among the 5 highest paid officers, shareholders that more than 10% of the value of the employer stock, or the 25 highest paid of compensation. So it's the top 25% are considered to be highly compensated. And you can't design a plan that benefits that favor just them. So that's the prohibited group. That's what you have to be very careful with and making sure. Now, one of the misnomers is that, especially with governments, because you're not subject to ERISA, you're not subject to these rules. It doesn't matter if you're a private employer or a public employer. If you have a self-insured plan, the plan has to be non-discriminatory. You have to pass the eligibility test. You have to pass the benefits test. So the penalty under Section 105H for failure to meet the non-discrimination rules is the fact that the employees are taxed on any excess benefits. And these vary depending on whether you're violating the eligibility test or the benefits test, because if you violate the eligibility test, you may have to include the entire benefit in tax, because no other highly compensated, no other non-highly compensated are participating. So you've got to be very careful in that regard. And again, if you have different features for different employees, each of those features have to pass the eligibility test, or it's deemed to be discriminatory. And again, health plans are included in cafeteria plans under Code Section 125. And one of the benefits of Code Section 125 is that these employee contributions are treated as employer contributions for all intents and purposes. It's excluded from income tax, Social Security, and Medicare taxes, so it's a lot of benefits. But please remember, there's all kinds of issues in that by putting money through a cafeteria plan, and I have in there advantages and disadvantages. Please remember that once you put these contributions through a cafeteria plan, any voluntary benefits that you put through a cafeteria plan, you basically have made them to be an employer-sponsored program, which means that it may affect the taxation of the benefits, because now you have employer contributions, but also may subject the benefit to ERISA. One of the other disadvantages is trying to make sure that the employees understand that once you put and you have pre-tax contributions or a cafeteria plan, you have to meet the requirements of the plan. And only under certain circumstances can you change your election. So the employee can't come back 2 months later and said, well, I don't want to be in this plan anymore, it's voluntary, and I can't afford the contributions. Well, unless they have a qualifying event, that employee is stuck, because you have to meet one of the qualifying event to change your election. And that makes it more complicated, and for the employees to understand that, I'm sorry, but you're stuck in this plan until the end of the year. Unless you have a qualifying event, we can't change your election under the plan. So, I mean, with the benefits of a cafeteria plan come all kinds of detriments, and you have to meet those rules in changing elections. Let's stop right there. And Amanda, do we have any questions?
Yep, we have a couple. The first is Section 79 life insurance still viable?
Yes, I'm going to be covering in a few minutes. So Code Section 79 is still there. There's some non-discrimination rules which I'll be discovering in a few minutes. Mm-hmm. So I'll be covering that. So I'm taking benefit by benefit.
All right.
But what I wanted to describe for medical benefits is the fact that you have to meet the definition of medical benefits under Code Section 213D. And one of the biggest misnomers is, especially when employers put in wellness programs, that everything under a wellness program is non-taxable. Well, it may not be the case.
Mm-hmm. Okay. The next one was self-employed and HRAs. Didn't something just change about this? And I assume they're referring to the small business HRA that we've covered recently.
No, it's still, I mean, the issue and problem is self-employed individuals cannot technically get pre-tax contributions under this plan. So again, that's the problem.
Okay. If an employer has insured benefit plans and differs benefits to different groups, there's no problem from a non-discrimination perspective for the insured plans. But if the employee pays for benefits under the cafeteria plan, doesn't the different benefit features and different costs present a problem unless tested as separate plans?
Well, and what many employers do in this situation is if they're offering, I'll give you an example. This is a perfect example. You pay for your executives medical program. You pay the entire benefit. You pay all the premium, but for the rest of your employees, you pay 50%. And you say, well, how do you get around this? And what I'm saying is, those executives, those medical benefits that are paid by the employer are not subject to the cafeteria plan. So any discriminatory benefits you don't put to the cafeteria plan because the employer pays for it.
Okay.
So that's how you get around some of these rules, by not putting the benefit in the, especially if the employer pays for that benefit, it's not subject to the cafeteria plan.
Okay. Regarding pre-taxing AFLAC premiums, or if an employer pre-taxes or pays for accident or cancer plans, is the benefit taxable?
Here's what they recently say. I'm glad you brought that, because we brought it up in a couple of seminars, and what people were concerned about, they were scratching their heads over this. How is that possible? Those benefits would be taxable. And if you look at the Chief Counsel memorandum, what they indicate is that because the payments don't exactly are reimbursement of medical care, they determined those benefits were not considered to be eligible medical expenses under 213D.
Mm-hmm.
And if the employer pays for it, or if the employee pays for it through a cafeteria plan, then any benefits coming out of the plan would then be taxable. So the secret is, in this situation, is that if you're going to do any types of those policies, what you have to do is do it with after-tax contributions. And then any benefits coming out would not be taxable. But the reason why they said that is because those benefits under those programs would not be considered to be medical expenses under Code Section 213D.
Okay. All right, and that's all we have for right now.
All right. Let's continue next for disability benefits. Disability benefits are provided by most employers. So there's both short-term and long-term benefits. Generally, payments are included in the employee's income under Section 105A, but benefits financed by after-tax contributions are not taxable. And that's what many employers decide to do. They don't put disability, if the employers are going to be paying for these benefits, they don't put them through a cafeteria plan. But again, if there's any payments to reimburse employees of qualified medical expenses, they're excluded. But if it's for disability payments, and it's not to reimburse medical expenses, again, those payments are going to be taxable if they're financed either by employer contributions which were not taxable to the employee, or cafeteria plan payments. And also any payments made to reimburse for lost body function or limb or permanent are also excludable. So again, sometimes you may have portions of a policy that are disability, but they also may have other sections that reimburse other expenses. And if there's an AD&D portion of it, it wouldn't be taxable. And if it's reimbursed medical expenses, it would not be taxable. So proper deduction, so if the employer pays for it, again, it's a deduction from the employer. And there's no authority for this, but the IRS has held that the disability payments constitute amounts paid through an accident and health plan. This is under Revenue Ruling 75-499. So again, employer can take a deduction for it. There's income tax withholding, and also there's FICA and FUTA. So basically, what this is, if the payment is taxable, it's treated as wages. So these are the various sites that talk about the various withholding and various taxability of these benefits. Somebody brought up, okay, Amanda, are there any questions about that? So again, in regard to disability benefits, if the employer pays the premium for the benefit, or the employer pays for it on a pre-tax basis, any benefits coming out would be taxable. But if the employer who pays the premium includes the premiums in the employee's income, the employee pays for those payments on an after-tax basis, again, any payments coming out would not be taxable.
So regarding the previous question about an employee pre-taxing their AFLAC, accident, or cancer benefits, what should employers do now so that they're in compliance with the law?
They have to be after tax. Now here's the problem with this AFLAC situation, and this is really because they're voluntary benefits. The problem with these benefits are the employer may not know that the employee was receiving benefits, and there's an issue there because of that. How is the employer going to withhold any income taxes if they don't know whether the employer's received any benefits? Mm-hmm. So you have to go back to AFLAC and say to the employer, to the AFLAC, could you give me a report for any employee that received benefits? Because I have to tax those, so you have to talk to the insurance provider to see if they're willing to give those records to the employer, because the employer may not know.
Yeah. So it's important that either your broker or your benefits administrator or you work with your carrier to ensure that you're all in compliance.
Correct. But again, most of these AFLAC policies are voluntary, which means they're individual to each employee. Mm-hmm. That's the problem. That's the problem.
All right. Well, that was all for right now.
Okay. Another common benefit is group term insurance. Very common with most employers providing that. This is under Code Section 79, and Code Section 79 provides that an inclusion income of an employee for life insurance, but only to the extent that such cost exceeds the sum of the following: $50,000 for such insurance, and the amount paid by the employee towards the purchase of insurance. Now, for any amount over $50,000, this is the amount that's subject to income. There was a table that was put in 1999. It hasn't changed. And the amount that's going to be included above $50,000 is dependent on your age at the time. That's the amount that would be included. So the first $50,000 is free, no income tax. So the coverage for spouses and dependents are not covered by this exemption. And such coverage has an exemption if the face amount does not exceed $2,000. Above that, it would be. Exception for coverage over 50, a former employee who terminated and has permanently disabled, there's an exception for that. Now, also, please remember there's non-discrimination rules under this program. If the plan discriminates in favor of key employees, either in eligibility or benefits, these employees are taxable on the entire cost of coverage. And the cost of coverage is the higher is the actual cost of the cost under Table 1. Now, who is a key employee? It's an officer. Compensation over, it's supposed to be $175,000. That's a typo. It's $175,000. A 5% owner or 1% owner with compensation excess of $150,000. So again, you have to be very careful. Now here, a plan will discriminate to eligibility if it benefits, it does not discriminate if it meets one of the eligibility requirements. It benefits at least 70% or more of the employees. At least 85% of the plan participants are not key employees. Or if the plan benefits employees under classification set up by the employer and approved by the IRS is not discriminatory. Now, if you put a group term policy under a cafeteria plan, if it meets the non-discrimination rules under code section under the cafeteria plan, it will not be considered to be discriminatory. So, and again, for eligibility. Now, 4 types of employees are excluded from the consideration determining if the plan discriminates. Employees who have not completed 3 years, part-time or seasonal, employees who are not included, collective bargaining employees, and non-resident aliens. Now, in regard to benefits, one thing that's important is in order to meet the benefit test under this, the benefit has to be a uniform relationship to participants' total compensation, which means that everybody gets 1 or 2 times pay as a benefit. So I'm somebody making $50,000, $50,000 a year, and my plan says I get a benefit of 2 times pay. That's $100,000, no problem. The executive makes $500,000, he gets 2 times pay. That's still not a problem because the percentage used is uniform. So the amount of the coverage doesn't have to be uniform, just the factor used involved. So as long as everyone gets 1, 2, or 3 times pay, there's not a problem. But in this situation, if the executive gets 2 times pay and everybody else gets 1 times pay, you have a problem. You have a problem. So again, you have to use a uniform percentage in order to meet this test. Any questions about insurance?
None at the moment.
Okay. Severance benefits. Again, another common benefit that many employers give executives. Under here, severance benefits are taxable to the employees. In some cases, are considered wages subject to federal income tax. And again, depending on what benefits are included in the severance package. Employers usually deduct severance benefits as ordinary income, necessary business expenses, and whether employers must withhold federal income and FICA taxes from severance depends on whether the severance payments are wages as defined under federal law, income tax, and FICA. Severance payments made to employees in connection with an involuntary separation are treated as supplemental wages and are subject to federal income tax and FICA. So in this situation, what's very common for severance packages, it will include such things as wages, medical coverage for a few months, and generally severance payments. One thing to remember, if you have severance payments of less than 2 years, 2 years or less, it's not considered to be unqualified deferred comp, a non-qualified deferred comp, as long as it's less than 2 years. Fringe benefits. Fringe benefits are becoming very popular. Employers are finding various ways of benefiting an employee without giving them additional income taxes. These you have to be very tricky and you have to be very careful in. So in general, all benefits and prerequisites must be treated as taxable income unless they're specifically exempt for taxation, which is, as I indicated before. The amount that is required to be included in the individual's income is based on the fair market value of the benefit. So this is what I said from the very beginning. Now, these fringe benefits, there's various different fringe benefits under Code Section 132. There's no additional cost services, and these are excludable benefits. First of all, no additional cost services. Services are provided free to employees for which the employer incurs no additional cost. This includes free standby air travel for airline employees. Hey, there's an empty seat, I'm going to go. that's not included in my income taxes. Qualified employee discounts. You work for a retailer, you get 20% off. That discount, is not considered a taxable event as long as the discount does not exceed 20%. So again, that's a fringe benefit that's not taxable. Working condition fringes, property or services provided to employees such as company cars or mobile phones, which are excludable from the employee's income so long as the cost of the perk would have been deductible with the employee as a business expense if they purchased the perk directly. But again, there's limitations on that. You don't include personal time or personal mileage in the company cars. If you're given a mobile phone, again, you have to be very careful when that mobile phone is used. Also, de minimis fringes. De minimis fringes, property or services such as a small value that accounting for such perks is unreasonable. A Christmas turkey, a t-shirt. Generally, those benefits, and sometimes employers use that for wellness programs. So if the benefit is less than $50, then you don't have to include, sometimes the employer will take the employees out to lunch. Things like that are considered to be de minimis fringes. And they're so small in cost that it would be really too much for the employer to account for all this and include $5, $10, $15, or $20, $25 in the employee's income. So there's various little things that the employer, employer will give the employees, and again, those de minimis fringes are not included in the employer. Now, you have to remember, you have to be very careful with certain things like gift cards and things like that, because gift cards are considered to be cash, so they can't be redeemable for cash. And a safe amount of that is if the amount of the fringe is less than $50. You have to be very careful, and some employers push the limit on this. So please be very careful with this. Qualified transportation fringes. Transportation subsidies provided to employees to defray the cost of commuting to and from work. These are parking, this is transit. Those perks are not taxable as long as you meet the requirements of Code Section 132F. So these are all excludable benefits, but you have to meet the requirements. Educational reimbursement programs, there's various programs under Code Section 127. There's educational reimbursement programs here. Payments are made to the employee under an educational reimbursement program are deductible if they qualify as ordinary and business income. Remember, it's to pay for various educational classes to support the business. If payments are made under this program are considered to be part of the gross income of the employee, an employee is required to withhold if they're not for business purposes. These programs normally are included in the gross income of the employee in the year the payments are received and are subject to the employment taxation, with two exceptions. It's a working class condition fringe. In other words, you have to get your NVA to keep your job, or you have to do a certification to keep your job. It's not taxable. Accountable programs, any type of an expense including education expenses that are paid and reimbursed under a accountable program that are excluded, so they account for the expense and it's for business. Another type of program is the Educational Assistance Program. This is under Code Section 127. Amounts are excludable from gross income if it's limited to $52.50 per year. The amounts are excludable from the employer's income if they meet certain requirements. If not, the expenses must be then treated as a traditional educational expense, and they could be taxable. Tuition reduction programs. And again, in this situation, if you are working for an organization that has a relationship with another institution, and here, because you are working for an institution, you get your tuition free. In this situation, those payments would not be taxable. That's what that slide explains. Now, other benefits, again, you have the dependent care credit, the adoption credit, legal assistance, if you meet certain requirements, are Code Section 120 included. Of course, dependent care assistance, adoption assistance, and health savings accounts are all benefits in various code sections that can be excluded, that can be given to the employees, and those payments are not considered to be taxable. But you have to be very careful with health savings accounts, especially with employer contributions. Employer contributions under Code Section 223 can be, again, subject to the certain rules. Employer contributions can be put inside or outside of a cafeteria plan. So if you make them through a cafeteria plan, you have to meet those cafeteria plan rules. Also, in this situation with health savings accounts, HSA contributions can be put through a cafeteria plan as long as you meet the cafeteria plan rules. Those employee contributions would not be taxable, and the employee doesn't get a deduction for them. Now, if employer contributions are not put through a cafeteria plan, there are a certain set of rules that you have to meet, and basically you can only vary contributions according to the coverage the employee has. You can give one amount for those employees who have single coverage and another amount for those employees that have family coverage. And lastly, deductions for funded plans. I just want to cover this in the remaining minutes I have. And in this situation, if you have a self-funded benefit program, there's certain restrictions which you can deduct under these programs. And I'm just going to cover this in a few minutes just to make sure. So if you self-fund any welfare benefit fund, the contributions are deductible to the extent that a qualified cost of the fund program under Code Section 219. Qualified costs means the sum of qualified direct costs and the amount that may be added to the qualified asset account for such year. Now, qualified direct costs, as this slide indicates, are administrative and benefits provided during the year. So somebody submits a claim, you pay for it. That's qualified direct costs. A qualified asset account includes two amounts: amounts to fund claims that incurred during the year but not paid, and amounts necessary to fund the administrative costs. This qualified asset account is basically your reserve. You're anticipating what costs you'll have in the future. So the amount an account must be established for the payment of disability, medical, supplemental unemployment, severance, or life insurance. And there could be, for example, additions to the qualified asset account. These are only allowed if the employer self-insures a reserve to set aside. So again, that's the reserve I was talking about. So you can, again, get a deduction for the amount that you actually pay. And secondly, you can get a deduction for the reserve under Code Section 219 and 219A. Now, reserves can be justified by experience, are permitted up until a specified dollar amount. And you can, again, fund for post-retirement medical. You can fund for severance pay benefits under the limits that you see there. Here, there are certain limits for disability payments, separate accounts for key employees, collective bargaining plans. There's no reserve limits for that. So the only reason why I'm bringing this up is the fact that if you're self-insured, you have to be very careful that actuarially, or you set one of the safe harbor limits to create a reserve if you decide. And the reason why I bring this up is because more and more employers are self-funding their medical, their dental, their vision, various types of benefits. You have to be very careful in deciding how much to take a deduction. these slides here to give you a guidepost of exactly how much you can set aside for the reserve. And again, these are various safe harbor reserve amounts. You can either use an actuary to create your reserve or use these various limits as a safe harbor. So again, you can do your direct costs and then 17.5% for short-term disability in addition to that as a reserve. So what these safe harbor the limits do, they tell the employer, okay, if you don't want to get an extra rate, what you can do is create a reserve, and these are the limits for short-term disability, medical benefits, and severance pay plans that you can set aside to pay for your benefits in the future. Are there any questions?
Yep. All right, just one second. Does an employer paying for a Costco membership for employees count as a taxable fringe benefit?
What kind of a Costco?
Yeah.
Yes, it would be a taxable benefit. Remember, it has to come under one of the code sections in order to be non-taxable.
Okay. Can an owner of a company deduct their mobile phone?
Yeah, off of their taxes, sure.
Are emergency child care payments, such as to a child care center or in-home babysitter, paid by an employer taxable to the employee?
It would have to be through a dependent care program and meet the requirements under the dependent care program.
Okay. That is all on our list for right now.
Does anybody have any other questions? We have a couple minutes left.
Yep.
As you can see, I tried to do the full extent on welfare benefits. Please be careful. And the reason for this seminar is to kind of tell employers when you're giving a benefit to your employees, unless it's covered by one of the code sections, as I indicated before, that benefit would be taxable. So you have to be very careful, especially under a wellness program or various other programs, to determine whether any benefit provided, either the fringe benefit, a medical benefit, or various other benefits, whether that benefit would be taxable to the employees.
All right. All right. We have just a minute, so if you have any other questions, please type them in the box below. Oh, could you explain, sorry, just one moment. Could you explain a little more about how an employee may have a better plan for higher paid employees than the, can you explain how an employer could have a better plan for higher paid employees than the benefit plan for lower paid employees without violating the non-discrimination requirements?
If you're insured, you can do it. If you have a medical program and you want to do that, there's no. When you start getting self-insured, that's when you have problems. If you have a self-insured medical program, you have to include enough lower paid people in that program to pass non-discrimination. So especially if you have a medical program, if it's self-insured, you really, if you're going to do a carve-out program and give the executives a better plan, it has to be insured.
Mm-hmm. All right, that's all we have for right now. And we're at the end of our time. A reminder, our next webinar will be on March 7th, again at 1 o'clock Central Time, and we will be covering FSAs and common issues.
And it's going to be issues with offering HSA. So if you offer an HSA, it's going to cover all the problem areas that you have. So I think it's extremely important if you're offering it to really think about attending, because we're going to go through some common issues. All right, thank you very much. Okay, bye-bye.
Bye.